The Reserve Bank of India, RBI, recently made headlines by announcing a record surplus transfer of 2.69 lakh rupees crore to the central government for the financial year 2024 to 25. This amount is not only the highest ever, but also exceeds the government's own expectations. But where does this money come from? Why does the RBI transfer it? And why is it called a surplus rather than a dividend? Let's break it down in simple terms so that even those unfamiliar with finance can understand how this system works. What is RBI surplus? The RBI, much like any other financial institution, earns money through various activities. After covering its operational expenses and setting aside funds for emergencies, the remaining profit is called a surplus, which it then transfers to the government. Unlike a dividend, which companies pay to shareholders, the RBI surplus transfer is mandatory under the RBI Act 1934. The amount depends on how much the RBI earns in a year and how much it decides to keep aside as a safety net. How does the RBI earn money? The RBI generates income in several ways. One major source is seigniorage, which is the profit made from printing currency. For example, it might cost the RBI only 5 rupee to print a 500 rupee note. But when banks buy these notes from the RBI, they pay the full face value, resulting in a profit of 495 rupee per note. Another significant source is interest earnings. The RBI lends money to the government, both the center and states, as well as to commercial banks, earning interest on these loans. Additionally, the RBI invests in foreign bonds and holds foreign exchange reserves. If the value of the rupee falls against the dollar, the RBI gains when it converts these foreign holdings back into rupees. The central bank also makes money through open market operations where it buys and sells government securities to manage liquidity in the economy. Why was this year's transfer so high? This year's surplus transfer of 2.69 lakh rupees crore is 27% higher than last year's 2.11 lakh rupees crore. The increase is due to a few key factors. The RBI sold more foreign exchange, forex, this year, earning higher profits. Its investments in foreign assets, such as US Treasury bonds, also yielded better returns. Another contributing factor was the depreciation of the rupee against the dollar, which boosted the RBI's earnings when it converted foreign currency back into rupees. These combined factors allowed the RBI to transfer a record amount to the government while still maintaining a healthy financial buffer. What is the Contingent Risk Buffer, CRB? The RBI doesn't transfer all its profits to the government. It keeps a portion aside as a safety net for financial emergencies. This reserve is called the Contingent Risk Buffer, CRB. Think of it as a savings account for the RBI to use in case of a banking crisis or economic shock. In 2019, a committee led by former RBI Governor Bimal Jalan recommended that the CRB should be between 5.5% and 6.5% of the RBI's total balance sheet. Recently, the RBI expanded this range to 4.5% to 7.5%, giving itself more flexibility. This year, the RBI kept the CRB at 7.5%, the highest end of the new range, yet still managed to transfer a historic surplus due to strong earnings. The transfer of surplus funds hasn't always been smooth. In 2018, tensions arose between the RBI and the government when the latter demanded a larger surplus transfer to fund its spending. The RBI, then led by Governor Urjit Patel, resisted, arguing that it needed to maintain sufficient reserves for financial stability. The disagreement became so intense that then Deputy Governor Viral Acharya publicly warned that undermining the RBI's independence could harm the economy. Reports even suggested that Prime Minister Narendra Modi compared the RBI to a snake sitting on a pile of money, highlighting the government's frustration. Eventually, the Bimal Jalan Committee was formed to establish clear rules on surplus transfers, bringing an end to the dispute. While this year's surplus is a record, it doesn't necessarily mean future transfers will be as high. The RBI's earnings depend on factors like foreign exchange sales, global interest rates, and currency fluctuations. If the rupee strengthens or the RBI sells fewer dollars next year, the surplus could be smaller. On the other hand, if the RBI decides to keep the CRB at the lower end of the range, 4.5%, more funds could be available for transfer. Essentially, the surplus amount varies each year based on the RBI's financial performance and risk management policies. You might wonder why this matters to ordinary citizens. The surplus transfer plays a crucial role in the government's finances. A higher surplus means the government has more money to spend on public welfare schemes, infrastructure, and subsidies without needing to borrow as much. This helps control the fiscal deficit, which in turn can influence inflation and interest rates. At the same time, the RBI must maintain enough reserves to ensure financial stability, especially during economic crisis. Striking the right balance between transferring funds to the government and retaining enough for emergencies is key to a healthy economy. The RBI's surplus transfer is a vital part of India's financial ecosystem. This year's record amount provides the government with additional resources to support economic growth, but future transfers will depend on the RBI's earnings and risk policies. Understanding this process helps us appreciate how the RBI balances profit generation, financial security, and national economic stability. Whether you're a student, a professional, or just a curious citizen, knowing how the RBI's surplus works gives you a clearer picture of India's financial health. The RBI isn't a profit-driven corporation, but it still generates substantial income through its operations. The surplus transfer ensures that these earnings benefit the public by funding government initiatives, while the CRB acts as a safety net for the economy. The delicate balance between these two functions highlights the RBI's crucial role in maintaining India's financial stability. If you found this explanation helpful, don't forget to like, share, and subscribe.